Hi, I'm Rachel and welcome to Yield&Grace. As always, my videos are not financial advice and always do your own research before investing. High yield ETFs sound like a dream, getting paid every week or every month just for holding shares. But before you invest in one, it's crucial to understand where that income is actually coming from, because not all yield is created equal. In this video, I'm breaking down exactly how these funds generate these distributions, including covered calls, synthetic exposure, leverage, and the different fund structures that power them, so you can invest with clarity and not confusion. When people hear high yield ETF, they often think massive income, but it's not magic. Most of these funds are option income ETFs, meaning they use derivatives, usually covered calls, or similar strategies to generate income. Now, the way they do it depends on the type of fund. Let's start with traditional ones. Funds like JEPI or QYLD. They actually own the underlying stocks or index positions, like the S&P 500 or NASDAQ 100, and sell call options on those holdings to generate premium income. That's the classic covered call model. Then there are the newer YieldMax ETFs. They do not hold the actual stocks. Instead, they use synthetic exposure, which means they use options and swaps to mimic the performance of a stock while selling call options on that exposure to generate income. Funds like QDTE or RDTE use a synthetic 0DTE covered call strategy, meaning they build exposure to an index like the S&P 500 using deep in the money flex options, then sell 0 day to expiry calls every single day to collect premium income. These are high frequency, synthetic, and heavily dependent on volatility levels. Now let's talk about Roundhill's weekly pay single stock funds. This is the group that many of you and I hold, like HOOW and COIW. These are not covered call ETFs. They do not sell options. Instead, they use a weekly pay leverage structure that aims to deliver 120% of the weekly return of the underlying stock before fees, while also paying out weekly distributions. So unlike covered call funds, HOOW and COIW generate their yield from the stock's total return and the way the fund is structured to distribute that performance to shareholders, not from selling options for income. That means their performance is more directly tied to how the underlying stock moves week to week rather than to option premiums. So let's recap the main groups. JEPI and QYLD own the assets and sell calls. YieldMax uses synthetic exposure and covered calls. Roundhill 0DTE, like QDTE and XDTE, use synthetic daily call writing on indexes. And then Roundhill weekly pay, like HOOW and COIW, are leveraged total return funds with no option selling. These are all different structures, but they have the same goal: to generate regular income just through different methods. So for covered call style ETFs, like JEPI, QYLD, or YieldMax, the income comes from selling call options. Here is a simple example. If an ETF is tracking Tesla at $250, it might sell a call option at $260. If that option brings in $3 per share, that's $3 of income for the fund. If Tesla stays below $260, the fund keeps both the exposure and that $3 premium, and that premium gets passed along to you as the distribution. Multiply this across thousands of contracts, and that's how these funds create those high yields. Here's the trade-off. They are giving up some upside potential in exchange for that consistent income. Some funds, especially like the weekly pay ETFs, like HOOW and COIW, use leverage, often around 1.2x exposure, meaning they're designed to amplify the underlying stock's performance by 20%. So if the stock goes up 5% in a week, the ETF aims to return about 6%. But if the stock drops 5%, the ETF could fall about 6%. Leverage can boost both returns and income potential, but it also amplifies risk, especially for volatile stocks like Robinhood and Coinbase. So now let's talk about why understanding this is so crucial. These funds can generate incredible cash flow, but you have to understand what's behind it. The income can come from option premiums, synthetic exposure, or leveraged total return. That also means when volatility drops, options income can fall. When the underlying stock drops, leverage funds can drop even faster. And since many distribute nearly all of their income, they do not retain profits, so share price can slowly drift down over time. Now we're gonna switch gears a little bit. I'm going to tell you guys how all of this ties into my strategy. One of my favorite things about these funds is how flexible the income is. If you use DRIP, your dividends automatically buy more shares, and those new shares generate even more income next time you get paid. If you use margin strategically, those dividends can help offset interest costs while still growing your portfolio. But both of those strategies only work if you understand how your income is being generated. Another question I get quite often is about taxes. Most high yield ETF distributions are taxed as ordinary income, not qualified dividends. And some include return of capital, which is not automatically bad. It just means part of your payout might be your own money being returned to you, which lowers your cost basis. So when you see a 100% yield, that does not mean the fund is making 100% profit. That is the distribution rate, reflecting cash flow being passed through. So before investing, here's a quick checklist. Does the ETF hold real stocks or use synthetic exposure? Is it covered call based or total return based? Does it use leverage and how much? Check whether the payment includes return of capital and make sure the fund structure aligns with your personal goals, which could be consistent income or leverage growth. So here is the bottom line. High yield ETFs are not all built the same. JEPI and QYLD use direct covered calls. YieldMax uses synthetic single stock exposure. Roundhill zero DTE ETFs sell daily index options. And Roundhill weekly pay funds like HOOW and COIW use leveraged total return structures. They all generate income differently. And understanding that difference is what helps you invest confidently rather than chasing yield blindly. It's important to note that there's not one structure that I like more than the other. I do my research to see what aligns best with my goals, and that's why I invest in YieldMax funds and I invest in Roundhill funds. So it's just really about figuring out what works best for you and what makes the most sense for you and your portfolio. If you found this helpful, be sure to give this video a like, subscribe, and I'll see you in the next video.